All right, class. Today we'll start talking about chapter 3. So you can think about this is class for June 12th. So before we start chapter 3, let's have a quick review, like some homework that is related to chapter 2. So I believe so far we have finished chapter 1 and 2, and we have gone over the difference between primary and secondary market, different form of business, average versus marginal tax rate. I believe you guys know that marginal tax rate means if you earn one additional dollar, what is the appropriate tax rate for that additional income. And average tax rate means on an average for your total taxable income, how much you should pay tax. Let's say your taxable income is $100 and this year you are paying $10 as a tax bill. So 10% is your average tax rate. In the last class, we solved problem 4 and about problem 5, the difference between market value and book value of assets. So let's say book value means the price or the amount that is reported in the balance sheet. So basically you can think about book value of any asset means historical cost after adjusted for depreciation. On the other hand, market value of asset means on the market, how much investors are willing to pay for that asset. So that's the market value. Now let's talk about problem 6 is a little bit. So problem 6 is asking for net working capital. So if you go to the slide, we know that net working capital is a function of current assets minus current liabilities. Okay. Now, if you go to the slide again, you can find the formula, right? What included in current assets and what included in current liabilities. So if you can't remember, I should say pause the video here and go and find those components. So current asset could have cash, would have accounts receivable, I'm writing as AR, would have inventory, right? Current liabilities could have accounts payable, I'm writing as AP. Sometimes notes payable. So from the problems above, which is 6, find out the values of these components. How much is cash, how much is accounts receivable, how much is inventory, how much is accounts payable, how much is notes payable. Plug in the formula, and you should get net working capital, right? So that's basically problem 6. So I think we are good so far from problem 1 to 6. But if you still struggle, have any confusions, feel free to reach out to me. Now let's start chapter 3. So basically, before we start chapter 3, I highly recommend either go back to chapter 2 or these 2 slides. Understand the basic components of balance sheet and income statements. So if you think about balance sheets, you have to understand what are the components of total assets, which is current asset, fixed assets. So what are the components of current assets? What are the components of fixed assets? And also think about what are the components of liabilities and shareholders' equities. So liabilities have current liabilities, fixed liabilities, current liabilities and long-term liabilities have more components. And then shareholders' equity has common stock, paid surplus, accumulated retained earnings. So make sure you know these subcomponents, some basic meaning, and how can you prepare a balance sheet if values are given, like how to plug in. So go over chapter 2 or think about this slide and make sure you know how a typical balance sheet looks like, and if you are given values, how can you plug in and create a balance sheet. Again, income statement. How a typical income statement look like? Starts with sales. From there, deduct cost of goods sold, deduct depreciation, you got EBIT. Just to let you know, EBIT is also known as operating profit. Okay, different names. Operating profit. Okay, from EBIT or operating profit, you should deduct interest expense and you got taxable income. It is also known as earnings before tax, EBT. From that, deduct tax, you got net income, right? Now, from net income, we learned in the last class, company can do two things: pay dividend or retain within the firm. Pay dividend or retain within the firm. Now, this is presented in a different way than last chapter. So in the last chapter, we learned total net income either kept or paid as a dividend. Here, they're trying to represent in terms of per share, okay? So this is total net income, okay? This is income per share or earnings per share. EPS means earnings per share. Same thing, income per share, earnings per share. So they're dividing the total income, which is 893, by the number of shares. That's it. So if you divide total income by number of shares, you will get earnings per share. So they're trying to say income per share is 468, and from that, they're paying 153 as a dividend. So that means within the farm, they're keeping $3.15 as a retained earnings per share. Okay. So make sure pause the video and understand the basic structure of balance sheet and income statements, because these are very important statements. So when you talk about statements, we know that from the last class we learned that statements is basically an area or a tool that corporation use to record their activities. Any activities related to asset and liabilities, they record in balance sheet. Any activities related to income and expense, they record in income statements. Anything related to cash flows, they record in cash flow statements. So now, if we look at statements, balance sheets or income statements, there is no benefit just looking at these raw numbers. Because just looking at this company producing $5,000 of revenue, it's really hard to tell whether they're doing well or not. If you want to evaluate certain companies' business operations, income, assets, liabilities, if you just look at raw numbers, it is hard to tell whether they're doing well or not. So there are basically two ways we can convert, or we can calculate some new tools so that we can compare this company with another company or this company across different time, so that we can at least make a decision whether this company is doing well or not. So if you want to analyze statements so that you can make a decision whether this company is doing well or not, there are basically two ways. So one is called common size statements, and the other is called ratio analysis. Why you want to do these two things? We want to do these two things so that we can analyze whether this company is doing well or not. Now, how can we analyze? So we can do two things. We can either compare firm A with a comparable firm, let's say B. So let's say in 2022, we want to compare how firm A did versus firm B did, because we want to decide which one did well. We can common size both corporation statements, or we can do ratio analysis. Or we can compare firm A performance across different time. So let's say we can common size or do ratio analysis of firm A for the year of 2021. Then we do the same thing for firm A for the year 2022. And then we can compare whether firm A did well in 2022 or firm A did not do well in 2022 as compared to 2021. These are the two reasons. If you want to analyze any corporation statements, we should do common size ratio analysis. Now, what is a common size statements? The name has the definition. So when we say common size statements, we're actually converting the statements into a common standard. You can think of common standard. Now, how can we do so? if we want to common size balance sheet, we should convert all the accounts. That means current assets, current liabilities, fixed assets, long-term liabilities, shareholders' equities, all accounts as a percentage of total sales. So you can think about, we're basically scaling all the components of balance sheet as a percentage of total sales. Okay. Now for income statement, we are converting all accounts like cost of goods sold, interest expense, depreciation as a percent of sales. So basically we're scaling all the components of income statement as a percent of sales. Okay. So this is basically common sizing. We are trying to converting all those statement values in a common standard. Okay, that's what it's called common sizing. Now let's do an example. How can you do common sizing? Okay, and then we will try to explain or interpret like how we can interpret common sizing values. Now here's the information: sales 1090, net income 213, net fixed asset 518, current asset 274. Firm has 88 inventory. What is the common size balance sheet value of which one? Inventory. What is the common size balance sheet value of inventory? So we know that inventory is the balance sheet value, and from the definition, balance sheet, convert all accounts in percent of total sales, right? So now, total assets, percentage of total assets. So it should be inventory divided by total assets. So the inventory value here is $88 divided by total assets is a function of fixed assets, current assets. It should be 518 plus 274. Just calculate it. I think it should be 11.11%. Makes sense. All the balance sheet accounts should be converted by total assets. Now, common size income statement value of net income. So all the accounts of income statement should be converted by what? Sales, right? So here, let's see. Net income should be converted by sales, right? So net income is basically 13 divided by sales is 1090. So that should be 19.54%. Makes sense. So this is basically 1 year common sizing of inventory and net income. So this is, I'm explaining how the process should be done. So in the next couple of slides, I'll talk about how to explain if we have multiple years of common size statements values. Now, if we go to homework, I think we just did this problem. Okay, we're also done with problem 7. Moving on here. So this is a hypothetical corporations. Let's say proof rock corporations. Okay. So 2017-18 common size statements, right? So assets scaled by asset is 100%. Makes sense. All are scaled by assets, right? So this is basically the asset side. If you look carefully, different components of firm's assets, they hold more cash in 2018 because in 2017 cash was 2.5% of total assets. Now in 2018 cash was 4% of total assets. So on a relative basis, they hold more cash, little more accounts receivable, and there is no change on inventory. So the total current asset they hold around 1.8% more. On the other hand, they hold less plant and equipment, which is fixed assets. Make sense? So now there are a lot of interpretation we can make. The first interpretation we can do is like, in 2018, from 2017, the firm has better liquidity because they have more cash, okay, better liquidity. At the same time, the firm invested less in fixed assets. One of the good things, they have better liquidity. One of the bad thing is like, if you want to generate return from the business operation, fixed asset will generate return. Cash will never generate return. So this is a bad thing because you did not invest on the fixed asset, rather you hold more cash. You have better liquidity, that's fine, but you may have some difficulties in generating return because you invested less or you hold less fixed assets. Now this is liabilities and ownership inside. You can see accounts payable increased very marginally, dropped in notes payable. Maybe they paid the debt over the year. And then long-term debt also dropped because maybe they paid the debt. On the other hand, they actually almost no change on the common stock and penny surplus. There's increased in retained earnings, which is a sign of they generated some net income and which they kept within the firm. They did not distribute it. So, and using that additional money, I believe they actually paid notes and long-term debts. So that's it. That's a good thing because you're paying your liabilities. That's a good thing. Now, income statement. Sales scaled by sales 100%. So you can say that for generating $1 worth of sales, the company has a cost of goods sold of 58 cents, or you can say 58%. Depreciation is 11.9%. Company's operating profit margin is 29.9%. So from $1 of sales, they actually pay 6 cents, or you can say from $100 of sales, they actually pay $6 worth of interest, taxable income, taxes paid, so net income. And from this net income, what they do? Dividends and addition to retained earnings. So if you sum these two up, 18.8. Makes sense? Any questions, feel free to reach out to me. So far what we did, we actually common size the statements and try to learn the process, how to common size and try to interpret, okay? So one of the problem of common size statements is like, you have to scale all of your balance sheet account by total assets, and you have to scale all of your income statement accounts by total sales, right? So the thing is that if you want to interpret any components, you have to interpret either in terms of assets or either in terms of sales. So we have little room to dig further. We have little room to explain further if we only do common size. On the other hand, for ratio analysis, we can scale different accounts from balance sheet and income statements by different accounts. So let's say we can scale current asset by current liabilities, not by total assets. So that's give us current ratio. That is a different interpretation that gives us a different performance standard. So basically the idea is ratio analysis gives us more independence and more freedom to scale different accounts by different accounts so that we get to know about the firms more. So that's why now we'll start talking about ratio analysis, okay? And the motivation is still the same. The motivation is still compare the same firm across time or compare the same firm with a comparable or competitor firm, okay? But the benefit is we have more independence for scaling, and that gives us better interpretation. So these are some categories of ratios which you're going to learn in this class. So the first important ratio is liquidity ratio. So what is liquidity ratio? So liquidity ratio means it actually gives us the idea about the firm, how liquid they are to pay their short-term or current liabilities, okay? So there are different liquidity ratios, current ratios, quick ratios, cash ratios, okay? So if we talk about current ratio is a formula of current asset divided by current liabilities. Now you guys may be wondering like where this number's coming from, right? 2168 current asset, 1995 current liabilities, where this is coming from. Let's go up. 2168 current assets, 1995 current liabilities. So this is coming from same slide. Go up. Okay. So if you divide current asset by current liabilities, you're getting current ratio. So it's telling that for $1 of current liabilities, you have $1.09 of current assets. So it's good. So it is recommended that current assets should be 1 because you should have at least similar amount of current assets to pay the current liabilities. Higher is always better, but you have also be careful that the more current ratio means you should not have a lot of money to invest in fixed assets to generate return. So you have to be careful, but at least 1 is required. Now, one of the problem of current asset is like it has cash, accounts receivable, inventory. Cash is highly liquid, account receivables is okay in terms of liquidity. Inventory could be liquid, could be illiquid. Now let's think about this way. There are two farms, farms A and farm B. So farm A is doing business. Farm A is doing business of bread manufacturing, right? Farm B is doing business of, let's say, wear equipment manufacturing. Now, for farm A, what are the inventories? That could be wheat, that could be flour, that could be some oil, that could be some water, or that could be some finished bread, which is easy to sell, right? So very liquidity, high liquid. On the other hand, what could be some inventory for farm B? It could be metals to produce those arms, bullets, and something like that. It could be some very complex machineries, complex equipment. That could be the inventory, so which may not be very liquid, right? So sometimes current ratio of one farm is not comparable to current ratio of one of another farm because these two farms are highly different in terms of the inventory holdings because their inventory may be bread, oil, flour, something like that. Their inventory may be metal, iron, something like that. So which is not easy to sell. So that's why it is recommended that you deduct inventory from current asset and scale by current liabilities. This is called quick ratios. There is no rule of thumb. What should be the ideal quick ratio, but higher is better. Cash ratio is a combination of cash scaled by current liabilities. No rule of thumb, higher is better. So this is the most liquid proxy for liquid ratios. This is the most liquid proxy to calculate liquid ratios. Quick ratio, sometimes also known as acid test ratios. So different professor, different books also call this ratio as acid test ratios. Okay. So these are some other measures of liquidity ratios, plus these three is highly used. And I already shown you this number is coming from balance sheet and income statement from this slide. Okay. Now, long-term solvency ratios, so we can think about debt ratios. Okay. So long-term solvency ratio is basically the other side of this ratio. So liquidity ratio is trying to tell you how strong you are in paying short-term debt or short-term liabilities. This is telling you how strong you are in paying your long-term liabilities, okay? So straightforward formulas. So I want to tell you that don't worry, don't afraid of formulas because you should have the formulas. Your job is to understand how to interpret, and your job is to understand how to plug in the values. So total debt ratio is basically total asset minus total equity divided by total assets. Okay. Where the value coming from? Let's go up. Total assets 5606. Total debt should be summation of these two. okay? And then this is total equity, 2768 divided by total assets. So if you go here, 5606, 2768, divided by 5606, okay? Just know how to plug in, okay? So understand these terms, how to plug in, interpret. So now this is trying to tell you 50% or 50.62% of your total asset is financed by total debt. Make sense? Lower the debt is better for you. For any corporations, lower the debt is better. So we're going to talk about it why lower the debt is better. But right now, just understand lower the debt is better, okay? Debt to equity. So that means total debt, total equity. So total debt, we know how to calculate total debt, total equity, okay? This is trying to tell you for $1 of equity, this firm has $1.03 of total debt, okay? So that means you're starting a business. You as an investor, stockholders investing $1, you are borrowing from outside $1.03 and investing or starting the company, okay? Equity multiplier, total asset divided by total equity, okay? You can also think about 1 plus debt divided by equity. So same formula, so both can work. So this is trying to tell you for $1 of equity, how much asset your firm has. So by investing $1, your corporations have $2 worth of asset, $2.03. It makes sense because here we said that you have $1, you're borrowing from outside $1.03, right? Now we know that asset is a function of debt plus equity, right? So your equity is $1, you're borrowing $1.03. 1 plus 1.03 is basically 2.03. Make sense? So this is long-term solvency. Lower is always better. We'll explain soon. Coverage ratios. Coverage ratio is trying to tell you how much operating profit you have to pay interest expense. Just to give you some heads up, if you borrow from bank as a loan, or if you issue debt like bonds, notes, something like that, you have to pay fixed interest each year. That's a fixed burden. We'll talk in later chapters. If you have loans, bonds, notes, which are like debts, if you have debts, you have some fixed burden, like 5% interest each year or 3% interest each year, fixed burden. Doesn't matter you're making net profit or not, you have to pay that amount, okay? You have to pay that amount. So this is trying to tell you how much operating profit or you have to pay interest. So if you look at the income statements here, interest expense, operating profit, okay? 1138 divided by 7. It's trying to tell you for each $1 of interest expense, you have 162 times more amount of operating profit. 162 times more. Or you can say that for each dollar of interest expense, you have $162 of operating profit to pay to your lender. Make sense? One problem of using this formula is like EBIT includes depreciation. Depreciation is a non-cash expense. So basically, it's not your cash generating capacity, okay? So we are now trying to think about in terms of cash, not income, okay? So that's why we are adding back EBIT plus depreciation. This is trying to tell you for each dollar worth of interest expense, you have $179 of cash, operating cash, pay interest. So quick recommendations. Higher this value, you have better capacity to pay interest. Makes sense? Inventory ratios. So inventory ratios also known as efficiency ratios. So this is trying to tell you how efficient you are in converting your raw materials into finished goods. So let's say you purchase some finished goods on January 1, and then it takes you around 3 months to process these raw materials into finished goods and sell it, okay? So this is inventory turnover, okay? So from raw material to ultimate sales, how long you need. If you use this formula, cost of goods sold, you have inventory. So this is coming from cost of goods sold, is coming from here. Inventory is coming from, I will not here, okay? So this is trying to tell you each year, you're at least able to make your raw materials to inventory a cycle 4 times. So each year, you're able to make 4 complete cycles to purchase your raw materials and finish it. Like so, okay? Now, if you are counting in terms of days, this is 91 days. So from buying raw materials to a finished good and sales, you need 91 days, okay? So basically, lower this value, better efficiency. Higher this value, better efficiency. Make sense? Don't care about the formulas, understand explanations, and understand how to plug in. Receivable turnovers. How long you need if you make a sales in credit? If you make a sales in credit, how long you need to convert those credit or convert those accounts receivable into cash? Okay, how long you need? So this is trying to tell you in a year how many times you can convert your accounts receivable in cash. This is in days, okay? So lower these days, you have better conversion, better efficiency. Now, total asset turnover. So this is trying to tell you, by investing $1 in assets, how much sales you can generate. So from the last example, we're trying to tell you, we invested $1 of equity, we invest $1 of 3 cents from the debt, so we invest $2. So by investing $2, let's say how much sales you can generate. So this is trying to tell you, by investing $1 of total asset, we're able to generate 89 cents of sales per year. Higher the value, it's better, okay? So we talked about liquidity, we talked about long-term solvency, and we talked about some turnover ratios, which are a proxy for efficiency. So this is so far for today's class. In the next lectures, we're going to finish chapter 3. Thank you.